Good afternoon to everyone. Professor Sesha Rao, Professor Lalwani, Vijay, other friends, and all the students and people from the business and in the industry. It gives me great pleasure to be here at the SPJIMR Institute. Mr. Lalwani was reminding me, and I do remember a very active bond markets conference that I had come for when we had discussed, I remember lots of issues on developing bond markets and the constraints. And I was trying to figure out how many years ago that was. I don't think we exactly hit upon the date. It's a really good idea to have this conclave. And I think Mr. Lalwani, in his introductory remarks, really set the tone. Because I think the one thing that financial sector is introspecting the world over, particularly after the global financial crisis, is this whole issue of the role of finance. What is really the role of finance? Can financial sector be pursued for its own sake? If the financial sector is growing at a much, much faster rate than the rest of the economy, and the financial sector, and the growth cannot be sustained, then the downfall of the financial sector brings down with it the entire economy. So I think that is really the kind of crux of the opportunities that financial sector has for being able to leverage and grow its incomes, grow its share in total wages, grow its share in the total assets, grow its share in GDP, and then also become responsible for exactly the kind of results that we saw. So I think, but this is the context in which the whole global dialogue and debate is currently going on. And in the emerging and developing economies which are caught in the maelstrom of this global financial crisis, it is something that, one recognizes the importance of the finance for growth, stability and equity in these economies, but equally important, we cannot be isolated from the international developments, be it in the area of the Financial Stability Board or the Basel Committee for Banking Supervision. So this is where the regulators play a very important role. The other reason I liked what he said about bringing academia and industry together is because the Center for Advanced Financial Research and Learning, of which I'm now director, which has been set up by the Reserve Bank, is also trying to become a platform for this kind of collaborative effort between the regulators, the market participants, market infrastructure organizations, and academia, and bring learning into research and bring research into learning. And I think especially when we look at the need for finance sector professionals in the next decade, the kind of need for the quality of people that we need, right from the top helm, right from the board directors level, right from the CEOs level, right down to the frontline sales force. I think it's something that, one realizes how does one really work with the sector to enhance competencies, to enhance leadership, to be able to really get the best out of people. So I think it's a very, very good choice of a subject. And like Suresh said, it's not really answering the questions. I think very often it's asking the right kind of questions that we come here for. So, like I started by saying that as a global crisis has shown, financial institutions and markets contribute to society as long as they contribute to the real economy. As long as they are doing intermediation between savers and investors, and as long as they facilitate the production of goods and services that people want. However, sometimes consumption in society can become totally credit-driven, as we did see it happen in the US economy, and not income-driven. And if the growth of income slows down for whatever reason, and the credit is not repaid, and the asset against which, and in that case it was the property, credit is given itself starts diminishing in value, this leads to grief. So where the system, similarly, where the system starts funding itself and exposing itself to financial assets that are several times the real assets and the real economy, then finance ceases to contribute to society and it can be harmful. So the ramifications of both the drop in the asset values of both financial assets and thereby real assets and the deleveraging process is so significant that the entire growth process gets derailed, as we have seen. In fact, the positive relationship between finance and growth, which has been accepted by all for long, is now being questioned, and a view is actually emerging that beyond a certain level, excessive finance is detrimental to growth and stability. So what is this? I mean, the debate that's really going on is what is this optimal size of the financial sector? What is the optimal composition of the financial sector? In India, however, the role of banking and finance is still very, very important. Penetration of finance is low. The real sector needs are still unmet, and we need more finance if we have to realize the potential for growth. So when we say financial services, what do we really mean? Obviously, it is saving services, loan services, pension services, remittances, payment services, capital market products, wealth management. All these services really go for the financial services. And in each of these sectors, in each of these services, there is, like we've all said, there is a huge informal sector and there is a formal sector. So I think you quoted 30% having a bank account, somewhere you say 60% of adult population has a bank account, 1% has a demat account, 5.5% of insurable have life insurance, and only 10 to 12% are covered by any kind of formal social security systems. Share of institutional credit, again, is quite low, whether it's in the rural areas or in the urban areas. Now, when we talk about share of institutional credit, we are talking about the share of the formal credit system. And the extent of informal sector in the remittances was considered to be quite high, and now that apparently is coming down due to the improvements in payment services. Now, it's interesting that society is not going to, if it's a desperate demand, it's not going to leave its demands unmet. So if you want drinking water, you're going to find some ways to get it. If you want fodder, you're going to find some way to get it. If you want sanitation needs, you're going to find some ways to get it. So similarly, if you want finance, the poor man will find some way to get it. The only issue is where the formal system is not able to give it to the give to the consumers what they need. The system either gets it from the informal sector at a fairly high cost and very low levels of efficiency, or it manages to live at a suboptimal level without those services. So from the point of view of a public policy, a formalization itself is a very, very important objective. In fact, so much so that previously I remember when I used to be looking at the regulations for the Know Your Customer, the rule, I mean, the sort of the benchmark there was the Financial Action Task Force and the Anti-Money Laundering Regulations, the Act which was enacted. And there the whole emphasis was, the kind of documentation needs that are required for knowing your customer. And all emphasis was on trying to get the compliance to deal with that kind of a documentation. More recently, I think internationally itself what has been realized is that actually putting all that list of documentation may be a very big deterrent for people to get into the formal sector itself. And by keeping people out of the formal sector, you're doing more for the cause of, what shall we say, it is more for the cause of terrorism or more for the cause of, keeping everybody out in the irregular market or keeping everybody out of the formal market, that is not the ultimate objective. So today their whole basis in which they're looking at KYC is what they call a proportionality criteria. You don't have a regulation, you have a regulation which looks at the proportionality, which means what is the consequence and the risk of that regulation vis-a-vis the risks of that regulation keeping people outside the regulation. So I think that's a very different kind of outlook which has come into the entire debate and discussion, and this is true in all our sectors. Whether we are going for insurance or whether we are going for old age pensions or whether we are going for loans, credits, actually even today the kind of activity that is there in financing outside the formal financial system is significant. After all, there are so many surveys, Arjun Sengupta report, or so many surveys which says SME units get 90% of their credit requirements from outside the formal financial system. So this is, I think, really for students of finance and for finance professionals entering into the field of finance, a huge challenge and a huge opportunity. So I would say that this is really the first challenge. The first challenge is how to meet the unmet demand. This is actually the stage of widening or formalization of financial markets. The next challenge is obviously to meet the potential demand. And in this, the question is, what is the potential for financial services in the, say, the next decade? In fact, for those entering the financial sector today, I would say this is going to be the most exciting decade for the Indian economy and for the Indian financial sector. If those of us who felt the last decade has been absolutely cataclysmic in its changes, and we've had a 5x growth in the financial sector, I think the kind of the coming 10, 20 years is going to be really, really very, very important. What have we seen in the last decade? We've seen the advent of retail banking. We've seen the growth of the new private sector banks, foreign banks, emergence of universal banking. We've seen banks and non-banks competing for similar segments of customers. We've seen IT-driven access to products and services, and we've seen focus on inclusive banking. What are we going to see in the next decade? Suresh mentioned about the demographic dividend that we will reap. A young population with median age of 30 in 2025, rising share of working age population, increase of 11 million to the workforce each year for the next 5 years, working age population to exceed 50% of the total population in 2025, India to account 25% of the global workforce by 2020, and dependency ratios to remain low till 2040. This is going to be the decade or 2 decades of the largest opportunities. It could be also the decade of the largest failed opportunities. I don't know. Households with incomes of over 50,000 per month will grow to 82 million by 2018 from 34 million currently. 40 million households will move out of the less than 2,000 per month category. There is resurgence in rural India. They estimate there are going to be 40 million middle and high income households in rural areas. In Indian corporate sector, becoming more and more global, their demands are becoming more and more sophisticated. And financial services, demand for financial services growing exponentially. They expect highly globally competitive and efficient services that link into their businesses. Today, businesses are actually providing facilities for companies to be able to link with all their businesses into with the banking, so that you almost on an online basis you're able to really undertake financial services. Now those kind of sophistications are what is coming. The growth in the incomes is going to drive the demand for more and more and better infrastructure services, for which there is a willingness and an ability to pay for such services. So all this has implications for banking and financial services. If we look, and this is from a study that McKinsey had done, and I was telling Suresh that this is also the theme of the Bank Economists BankCon conference, which was held by Bank of Maharashtra in November 2012, where for the research which they done showed that over the last decade, Asian banks accounted for 47% of global banking revenue and delivered 20% of the total shareholders' returns. In fact, against this, the European, Latin American, and North American banks' contribution to revenue pools was only 18, 15, and 15% respectively. Indian banks actually delivered an average shareholder return of 54% during the 5-year period 2002 and 2007. And this was mainly on account of the differential in the overall growth rates between Asia and the rest of the world. So geography really emerged as a prime determinant of performance. In fact, the research further showed that even within the geography, the differentiation between different market players was not that significant. Even the best of the market players was not that much higher than the median. And even the worst, was pretty high. So it was really geography which was determining the performance. And for the next decade, they do expect that the banking revenues will account for, the Asian banking revenues will account for the bulk, 45% of the growth in the global banking revenue. Now, they have done a study which says the 8 drivers of growth will be the opportunity offered by the middleweight cities and the multiple channels of access. In fact, a very interesting part of the research is how more and more of access is happening through other than branch outlets. How more of access is happening through ATMs, how more and more access is happening through mobiles, through internet and points of sale and through call centers. So it's really the branch as a single point of delivery is really no longer the case. It has become absolutely a multiple channels of delivery. Then the lower IT costs which have happened, the entire revolution in electronic payment systems that has happened, and the potential offered by the MSME sector and the infrastructure. So if we were to put it in a very short, pithy phrase, the potential for financial services in the retail segment in India lies in young India, urban India, and the rural market. The 14 centers, urban centers, have been identified as fastest growing, and the entire clusters around these centers, which cover another 10, 15 urban centers, account for almost 55% of the growth in the financial services. So this is going to be a key, these centers are going to be the key drivers of the growth in the financial services sectors. There's also another huge potential and growing market of the digital high value consumers. In fact, the country has 112 million internet users who are expected to more than double by 2015 to 250 million and accounting for 45% of savings. These are the smartphone users, these are the people for whom the delivery has to be really very sophisticated. The smartphone will become the dominant access point for such customers. And of these internet users, 27 million have been identified as potential digital high-value consumers, aged between 20 and 45, living in 8 top cities, having monthly incomes of over 50,000. So a poor virtual experience, a lack of a differentiated offering, and the trust of security concerns can really create a dent in your sales, and it can lead to a drop-off at every stage. The other potential areas for business is obviously the rising middle class, the rural affluent, and the needs of the corporate clients and agriculture innovation. So once one has recognized this huge potential for financial services in the next decade, what are the challenges that we have for unlocking these potentials? And I just want to refer to 4 challenges. The first challenge is obviously the challenge that industry itself has faced. Because I think it's all of what Suresh mentioned here, to provide customers with products and delivery channels that are safe, convenient, and user-friendly. There is a differentiation. Every industry needs to find its own areas of strength and advantages to be able to offer something that is going to be a winner. In particular, the public sector banks have to seriously look at their staffing, technology, and business processes to optimize the best of the human power and machine power. The front office or the sales force productivity will have to increase through IT, innovation, better processes, better execution. Rather than cloning each other, everybody needs a 444-day deposit. Rather than cloning each other, why there should be something to try to differentiate. The different markets have got different kinds of needs. Pensioners, we have recently taken a leadership program to Indonesia, and there we found that the bank has built up an entire huge business model just based on pensions. And that has led to so much other businesses coming out of what they gave a unique value to these people. So I think there is a potential, there is a scope for a huge amount of innovation. Now again, I think there has to be, and I would say this particularly for public sector banks, because the top management does keep changing in these banks. And the craft should not change really with every change in the top management. So if you're looking for the long haul, there is a very important need to build up an institutional culture that remains unique for that bank, even where there is a change in the top management team. And this would really call for imbibing a kind of sense of values and mission across the bank, which is reinforced within the bank every time they're doing a business performance, making a business plan or evaluating their own performances. And I think that kind of building up of the institutional culture uniquely to that bank and seeing that the message is really carried across to every nook and corner of the bank is critically important for large banks which are growing and whose top management may not necessarily have the kind of continuity that one would like to. The second challenge is the size and structure. I referred to this discussion and this debate before. The size and structure of the optimal size and the optimal structure of a banking or a financial system for a country. What is the global discussion on this? The global discussion on it is systemically important financial institutions. What sort of systemic risk do these institutions contribute to? How should one be regulating the SI, the cities as they are called? That is the debate. The debate is around separation of investment banking and mainstream banking. There is the Vickers and there is the Dodd-Frank. I mean, these are the issues that are really, engaging the attention of the regulators. There is a question of moving away from more complex banking to more simple banking. There is a move away from universal banking to more straightforward traditional banking. So this is the kind of debate that's going on because the financial sector has become too large, too complex, too linked up in so many structures within structures that it's very difficult to really understand what's happening. There are also issues being raised on what is the optimal size. And what is the relevance of this debate for India? Should large banks in India be curbed in their growth because they are considered systemically important? How should banks be reckoned as systemically important? How should any institution, whether an insurance company or a pension fund or a mutual fund, be regarded as systemically important? Compared to this is on the one hand. So then you get into issues of do you have to start curbing their growth? On the other hand, when you compare it to their global counterparts, Indian banks are tiny. So even if all the banks were taken together, the needs of some of our largest corporates is beyond the exposure limit of all the banks' capital taken together. So therefore, then what should we be doing? Should there be more consolidation? Should there be this whole discussion on entry of new banks? These are obviously all matters which are at the heart of the discussion. And every aspect which we had taken for granted is now coming again for revisiting. What should be the role of foreign banks in that? In fact, the crisis has really pointed out that the foreign banks, having an overly dependent structure which was dependent on foreign banks was to the detriment of countries. So today every country is looking at one, subsidization of the foreign banks, and two, so that you have more within the control of the national regulator. And the second issue is whether one should really be having a dominant role of foreign banks in any jurisdiction, because it sometimes can work against the national interest. Then there is this whole role of the public sector. Public sector, everybody was decrying the role of the public sector in banking or state intervention in banking. Today you find that because of the bailout of banking, there seems to be much more need, and actually when you look at it, there are many banks that got nationalized in the process. There is a need for looking at public sector as well. So does it lead to a more differentiated kind of behavior? You have one group of banks chasing profits and you have one group of banks maybe chasing objectives other than profits. But it's still a matter that one has to, debate. What is the role of universal banking in India? What is the role and regulation of non-banking financial companies and cross-border financial flows? Now these are all matters which have now come for fresh scrutiny. All the received wisdom is being questioned and challenged. And all these issues have now come for fresh scrutiny, just as much as independence of central banking, inflation targeting, all those issues have also, come again for debate. In fact, I would say there is really need for an extensive research on these issues, particularly looking at the experience of the emerging and developing economies. Last year I had given a speech in the Founders Day in Karnataka Bank, and there, because it was Karnataka Bank, I was trying to look at, to see whether small regional banks, as compared to their national counterparts, had actually differentiated in terms of their businesses. Have they any unique advantages that one can say, okay, here is a small regional bank with a local premise. Have they been really, have they been able to hold up? Now, although they have, in fact, what we found is that they have lost market share. And their outreach was not as broad as their large national counterparts, although they were quite efficient. So, where then, they have the wrong strategies? Where did they not adopt the strategies which would have given them the advantage of that niche marketing? On the other hand, several non-bank players, which were again niche players, they have proved to be very nimble-footed, serving smaller segments competitively while ensuring solvency and soundness and higher rates of growth compared to the banking sector. So we do need banks of significant size that can meet the needs of infrastructure, and we do need banks to provide services to such a pluralistic society such as India. The third challenge is really to ensure the fiduciary role played by the banking and financial services industry. And this is all about responsible finance. This is all about ensuring responsible consumers, no doubt, but it's more about ensuring responsible professional service providers. And if this is an industry in which you are aspiring to get into, I would say this is going to be a very, very important aspect of the culture and aspect of even teaching. It is very important in the insurance sector, the capital market sector, retail banking. I remember the member of IRDA, who was formerly member in SEBI, and he used to be with Corporation Bank, Mr. Nair. He said that his wife went into the bank to renew a fixed deposit and came out with an insurance policy. So he said now, this was quite difficult on what was happening. Because what was the incentive system resulting in? What was the compensation, mechanisms that were creating this kind of a thing? So we keep saying, in India it will not happen, we are all very well regulated, these things don't happen. But I can recollect 3 clear instances during the last 5 years where there's been evidence of mis-selling and even irresponsible finance. One was clearly the ULIP. The other one was the derivatives, the Tirupur exporters or whatever you might like to call it. And then you have the microfinance, debit and entrepreneurship. So there have been, so it just means the need for this responsibility in providing finance by financial professionals is so critical. Mainly to the uninformed and the vulnerable, it becomes even more important. Hence, ensuring fiduciary responsibility is tremendously important. Reputational risk is a major risk in this industry. In fact, we have lots of examples of this in India. Trust, once destroyed, is very difficult to rebuild. And to rebuild, it takes many, many years of consistent effort. And building business with trust and responsibility is a key, I would say, in this customer-centric sector. So as the financial sector grows, the consumer protection, financial literacy, it becomes even more important as also a mechanism for dealing with customer complaints and grievances. The fourth and the last challenge to which I will allude is the regulatory environment. Now the global regulatory environment is moving towards capital, more capital buffers, rejigging the basis for calculation of risk, especially the trading book, for counterparty exposures, liquidity requirements to control mismatches, a maximum leverage ratio as a backstop, central reporting and clearing of all trades in all what is collectively called the Basel III. Now, as a member of the global banking system, India has to fall in line with these regulations, but there is scope for national discretion in several areas. While we cannot take the view that what happened elsewhere will not happen in India, we have to be mindful of the fact that a considerable part of the society is outside the purview of formal finance, and this was my first point, and that there is a need for development of financial markets to meet the needs of long-term borrowers, such as in the housing and the infrastructure sector. We have also to realize that we are a bank-centric financial system with a dominant share of financial assets with banks, and banks will therefore continue to have to undertake maturity transformation for quite some time. We might easily say, no, we should have corporate bonds. And then you have corporates, floating bonds. Now, who's going to invest in those bonds? Unless the banks are providing some kind of credit enhancements, insurance companies and pension funds do not have the kind of bonds in which they would be eligible to invest in. So unless you really do have long-term savers emerging in the system, it is going to be the bank. And in the banks, the liability structure is becoming shorter and shorter in its maturity. So we can be sitting on a huge amount of mismatch. Do we mean to say we should not meet the long-term financial needs of the industry? So or are we going to wait till the long-term sources of saving are going to increase? So I think these are the questions which are not only linked to banking, these are linked to what is the total system incentives for long-term saving? What is the system's incentive for shorter-term saving? To my mind, it seems it's all the stats are for saving in the short term and rather than in the long term. So we have to look at this as a society itself, so we strike the right balance between the needs of the economy and the needs of the customers. So constant review of regulation is also therefore needed, and this is continuously done. So we strike the right balance between the stability, innovation and growth. On the side of the bank and other players in the financial system, what do banks themselves have to do? They have to conserve capital. They have to adopt better risk management practices. They have to manage and control their NPAs. They have to undertake proper risk and cost-based pricing. Pricing is a very, very risk-priced kind of structure that we have. We have to ensure performance incentives that are aligned to risk-adjusted return, not necessarily in 1 year. This whole short-termism, obsession with the annual balance sheet and the quarterly results. How much is it in the interest of the system? Should we not be really then looking at more longer-term incentives and longer-term performance reviews? And raising capital at the right time and the right amount at critical times will be critical factors that will ensure that their growth is not inhibited because of capital. So the question that is being raised is, how will the BFSI industry, will it be able to grow at the same rate as it has in the past decade when the return on capital is going to be reduced due to a tighter regulatory regime? This is a very big question. After all, if you have a return on equity in the financial sector industry, which has been returning better than the rest of the industry, it has been attracting more capital as well. So will you be able to attract the same kind of capital to be able to grow? And when I say the need for growth is immense, then how is it that we will achieve? So I think the answer to that is firstly, it is all question of relative return to other segments. And what is the opportunity in this segment? Because there are inefficiencies in this segment, because the margins in this segment, and because there is a lot of under-penetration in this segment, I feel there are definitely opportunities for a good return on investment. But the question is also that as banks are perceived to be safer and better capitalized, and their disclosures are credible, they will be better valued by the markets, and then they will be able to source both equity and debt at a lower cost. And finally, I come to the issue of ethics, which was also very rightly raised. I have touched upon it in the context of fiduciary responsibilities, but I think there's a very important issue of the governance, the proper disclosure, the transparency, the credibility in managing conflicts of interest, the competence of the board of directors and senior management, and effective supervision. They say regulation is only half the tea. In fact, regulation is only 20% of the tea. The real important thing is how is regulation enforced, and is it enforced? How is the supervision effective? And is there a quick, timely action that is taken to correct any kind of excesses that are going on? I have raised the issues and the challenges. I don't want to provide the answers, nor do I claim to know them. I hope you will debate these issues and others in this conclave, and I would very much like to hear your conclusion later on. Thank you very much.
We would request everyone to please introduce themselves, the organization that you represent, and kindly keep your questions brief so that ma'am can answer more questions.
It is the second AC compartment. I put a question to them. If it is same comfort, second AC comfort, if it is same distance, 192 kilometers, Bombay to Pune, they are traveling along with me. Then yesterday you were there in Germany. how much could you have been paid? That's one lady caught it. 50, 60 euros. What is the next question? Of me, what is the problem of saying 50, 60? We will to pay here. What is the problem? She is the student. She was not able to give an answer to this question. But I am keep on writing like this forums. What is the problem? Same cost of service, wherever in Germany, wherever in developed countries, wherever it is. Why can't we ask them, at least if not 50, 60, yes, that passengers paid here 6 euros. Bombay to Pune, they paid 6 euros. Then why we cannot make such another 6 euros? Anyway, they can pay, they have a paying capacity is there. Why we are asking them to pay rupee terms? What are the problems? What are the problems?
A small request to please brief your questions.
No, I mean, I'm not able to get the purport of your question. But I presume the question has got a relationship to the financial sector industry. When you're talking about differential costing, now obviously in what, I mean, are you saying there should be a difference between what one is charging an overseas customer and a domestic customer? I don't think so. I think what you're trying to say is that why is it that we cannot price our services more in line with cost?
No.
Is that the question?
No, we are offering at 360 rupees in India from Bombay to Pune. But if you convert it into euro, that is 6 euros. But in terms of, if you pass on our sacrifice and all, our workers' sacrifice and all, that in India, pricing is only in a year. That too, minister accepts. In a year, we will increase the rate.
I think we'll have to discuss this offline.
Offline. This is a very big subject.
Good afternoon, ma'am. My name is Gokul Agarwal and I am into wealth management industry. My question is about the banking industry, although it's not from my field. There has been a lot of talk about new banking licenses over the last 4 or 5 years. What I am not able to understand is there are a plethora of banks in India. There is no shortage of banks. Why is it that we can probably ask the banks to go broader, to go more deeper rather than giving more banking licenses? In fact, if you see a couple of banks which have just come in sometime back, like Yes Bank, I mean, of course, they are mainly in urban areas. Why are not banks going rural and going deeper rather than giving new banking licenses?
See, this is quite a difficult question to answer. One view is that there are enough banks in India, it's just that everybody seems to be doing the same thing, they're not doing something differentiated. Now, to a certain extent what you're saying is right. But see, I would say that once you have licensed a bank, it is in India that we have a fair degree of intrusion into their business model as well. Because you do have a certain amount, they have to invest in government securities, and you do have a priority sector lending, and you do have branch expansion that you can do. 25% of your branches should be opened in the rural areas. And this is, and plus you have the public sector banks whose objective itself is to move towards that. So there's a fair amount of intrusion in even the business decisions of the banking system. And that is not something that is very common throughout the world. In fact, most of the world, once you license a bank, they are allowed to do their own. Now, the question could come if the banks which are already here are doing a certain kind of model and are not penetrating into the underbanked areas and into those segments of society which really need to be penetrated. Why would you imagine a new bank would do it? That could be, a relevant question. Now, I would say that here is a question, here the answer to this question is really shared from the point of view of more competition. See, there could be a business opportunity that has not been tried out by the existing bank for whatever reason. And there could be a business opportunity which is, and when you are really looking at a specific objective that you want to, want the new bank to do, then that could even be made a part of the licensing condition. that you do this. So I feel that there is, when we have looked at the figures that I showed you, the opportunities for low-hanging fruit have been so immense that the banking system has actually taken advantage of that. So as competition increases, you will get into more and more of the penetrating areas. And to that extent, having a freer entry is not a bad, idea. No, second question, yeah.
Madam, I am Srinivas, working in SPJIMR Academic. Tapping the business potential in financial services should not lead to misselling. The current regulation, whatever in India, are sufficient to curb this. Say ULIPs, derivatives, structured products. Even with new licenses, we can expect more structured products. How better we can save the wealth even more.
So I think, I think I've given quite a bit of the answers in my lecture itself. But I think it's also a question of when you're actually selling there are a couple of suggestions here. One is that for every market segment, you have a basic product, which is a plain vanilla product, which has a no-frills product. And that is something every provider should provide. So that you can at least take care that this product doesn't have any kind of structured aspects which could be to the detriment of the customer or that he doesn't understand. So I think that is the one thing to ensure. There has been some discussion on this whether we should really get every product approved by the regulator. Now that could also be curbing innovation. So one can say and in India when you actually again go back to the last 5-6 years, the people who've been maximum taken for a ride are supposed to be the wealthiest and the most well-informed customers. So I think there is a need for actually having a proper sign-off. You might have that 10-day look-in time, but the look-in time may not be effective at all. So there are lots of practices like that which we should be really looking at. Many of this is in the small items, but I think the consciousness that you don't want to sell at all costs. And then what is in fact this was a matter of discussion a few days ago, that how do you align compensation to right selling? If you align compensation only to selling, and then when there is a complaint brought to your notice, then you terminate that fellow's job, is this the best way of incentivizing proper behavior? I think businesses have to ask themselves this question. So I think there is a need for introspection on the issue.
Hello ma'am, my name is Sachin, I am from SPJIMR. My question is that in India, recently the RBI and the government have been saying that you also said that you have to increase the financial penetration in India, particularly. So they are talking about increasing the number of banks and their branches. Why not are we using post offices, which also form a part of alternate financing monitoring, to access to rural India, modernize it and link it or integrate to a core banking kind of system?
There's already a proposal for India Post to really modernize itself, and it's I think quite in an advanced stage. Now, the post offices provide saving services and remittance services. It can also sell third-party products, insurance and capital market products. We had also envisaged the post offices to act as business correspondents of banks, but that experiment did not work. The issue is, can post offices give loans? Now, credit underwriting decision, as we see, is the most difficult decision, and then you will have to bring in a regulation, which is like a banking supervision and regulation. So that is the real tough part. See, how do you ensure that the regulatory burden in a society is not too high? And so if you have the post offices mobilizing deposits. In fact, this is the reason why we don't allow non-banks to mobilize deposits. Because the burden of regulating the protection of a depositor's money is enormous. And so it's much better to say that, okay, let banks mobilize deposits and let the others, originate the loans and banks can acquire them maybe through a securitization or something. So one has to develop efficiencies even within the regulatory sphere to see what businesses really different organizations can do. But if post offices started doing loans, then you have to have all kinds of mechanisms for supervision at various levels in the post offices to actually do it. But I don't know what the new plans for the post office are, whether the loans, I mean, I'm not no privy to it, but I think this is where they cannot, I feel, become full-fledged banks. Yeah, you can. Okay, there.
Good afternoon, ma'am. I'm Ankita from SPJIMR. My question is regarding microfinance. Recently, the government put a cap on microfinance at interest rate of 32% only. But for a person who is borrowing 10,000 rupees, a 32% interest rate is also an exorbitant amount. So, are there any schemes that help?
No, you said the government has put a rate of 22%.
No, 32%.
No. Anyway, it's much lesser, but even if you're justifying 32%, the question is that you're saying even that is a high burden.
What I'm saying is, are there any schemes that help the microfinance sector? Because take it for granted that the people who are providing microfinance are also taking a heavy risk. So, is there something that can help both parties?
I'm really interested in your question. The people who are taking microfinance are taking the risk, or the people who are giving microfinance are taking the risk?
Giving microfinance.
Okay. The question is also then 32% is too high a cost for the borrower who's taking a 10,000 rupee loan. But the cost of providing that service, do you feel it has to be covered or not? Do you feel that the risk of the loan being repaid should be covered or not? And do you feel there has to be some leftover for the provider or not?
That is why it's a paradox.
So it becomes. So therefore, this is where it all really comes. So having giving small loans in agencies which have the lowest cost of funds is in a way advantageous. So actually, banks in the Indian society do have the lowest cost of funds. So if we are able to get banks to do microfinance, then that's the best model. But unfortunately, banks prefer to target a slightly higher ticket customer. Targeting a 5,000 rupee, 10,000 rupee customer is very high cost for them. So you have to have what is then the role of intermediaries. So at the same time, the Reserve Bank has got priority sector lending guidelines. So while we may not get into the interest rates for everything else, in a way when you don't do priority sector lending, then the shortage that you have has to be deposited with NABARD at a very low rate of interest. So indirectly, by allowing you to do microfinance, and irrespective of whatever rate you charge, there is a kind of misuse of that inherent subsidy. So this was the context in which this came. The interest rate ceiling came in the context that if you want it to be treated as a priority sector loan, then there should be a ceiling on the interest rate the ultimate borrower is paying. And in fact, I would say the margins that were considered at that time to be reasonable was 8 to 10% at the level of the microfinance industry, which obviously can be achieved but by better efficiencies and better scale.
We have time for just one last question. I think since ma'am is here, we don't want to lose this opportunity. Just one last question from you.
Yeah.
Many reasons for the rate cut and the rate increase. Can you give us the exact parameters which
I want another 1 hour lecture. it's a real inflation growth, trade-off. I mean, it is really, the whole dynamics is that beyond a certain rate of inflation is inimical to growth. Now, what is that rate of inflation? And what is that kind of fund?
before broader timeline we don't have to declare that. So everybody says that okay, economic government 25% is down, rate cut will happen. But everybody is talking different. So many rumors are there and so many.
No, do you want me to tell you what is Mr. Subbarao going to do on? See, the parameters which Reserve Bank uses are very, very transparent.
They have as much information as you do, and not more. And it's all spelled out. What is the global factors, domestic factors, commodity, inflation, fuel prices, pass-through inflation through fiscal deficit, price of oil. I mean, just about every factor that influences the decision is available with the Reserve Bank, is available with you. People will say different things, and then half of them may be right, half of them may be wrong also. See, it's a judgment. Ultimately, it is why it's called the art